All right, let's get right into it. Today, we're moving past just looking at big, flashy candles and chasing them. We're going to learn how to actually read the story they're telling us, and more importantly, how to tell the difference between random market noise and a real institutional footprint. Come on, we've all been there, right? You see the price just taking off like a rocket. That FOMO, the fear of missing out, it just grabs you, your heart starts pounding, and you dive in, totally convinced this is the move that's going to make your month. And then, bam, the very instant you click that button, the market hits a brick wall and screams back in the other direction. You're left sitting there in a losing trade just thinking, what just happened? It is one of the most maddening things in trading. But here's the thing. What if that explosive move was never what it seemed to be in the first place? Okay, so this is where we get to the core idea. The big secret is to stop seeing all big moves as the same thing. We have to learn the difference between what most retail traders call momentum and what the big institutions are actually doing, something we call displacement. So first, let's talk about the trap. This is what almost everyone chases. It's just raw volatility, a sudden burst of energy that can pop up anywhere, often stuck right in the middle of a trading range. There's no real purpose or story behind it. It's just noise. Now, this is a totally different beast. This is the real aha moment. Institutional displacement is not some random spike. It's a deliberate, calculated move by smart money to reprice the market. And it has a very clear signature. It always grabs liquidity first, it breaks key market levels, and it leaves behind a very specific clue, an imbalance. So if you're going to remember one thing, it's this. One of these is just chaos, and the other is a clear message. Retail momentum is just volatility. But institutional displacement, that's a statement of intent. It's a deliberate and powerful shift from one price level to another. And honestly, that's the entire game right there. It has nothing to do with how fast the candle is moving. It's all about asking why it's moving. Was there a purpose? Did it accomplish something significant on the chart? That's how we start trading the narrative, not just the price. And you can really see the difference when you put them side by side. Look, true displacement is so methodical. It always begins by taking liquidity. It's basically grabbing pools of stop-loss orders to fuel up for the real move. And the candles themselves tell you everything. You'll see these big, full bodies showing real commitment versus those spiky, long wicks you get during a news event, which is just pure chaos. Okay, so we know what to look for, but how do we spot it happening in real time? Well, there's a blueprint for it. A repeatable, four-stage sequence that these high-quality moves follow almost every single time. Here's the sequence. First, price goes on a hunt for fuel. That's the liquidity grab. Second, you get that aggressive displacement move that breaks market structure. Third, and this is the absolute key, price pulls back to rebalance the inefficiency it just created. And finally, step 4, that retracement gives us our high probability entry point. I really want you to burn this into your mind because it's maybe the most important rule here. If you chase that big explosive candle in step 2, you are the liquidity. You're the one funding the move. The professional way is to sit back, stay patient, and wait for the pullback in step 3. The big move shows you their hand. The retracement is your invitation to join them. So where exactly are we looking to get in during that retracement? Well, this leads us to one of the most powerful tools for trading this whole idea, the fair value gap. See, when price moves with that much force, it literally leaves a gap in the market, an area of inefficiency. We call that a fair value gap, or FVG. Think of it as a footprint left behind by the institutions. And the reason it's so powerful is that markets hate a vacuum. An FVG is a one-sided pocket of price, and the market has this natural urge to go back and rebalance it, to make it efficient again. That's our window of opportunity. But look, not all of these gaps are worth trading. You only want the A-plus setups, right? So run every single one through this checklist. Did it form right after a major liquidity grab? Is this happening during the London or New York session? And most importantly, does it line up with the bigger story on the higher time frames? This little checklist is your quality filter. Context is absolutely everything in trading. Where the displacement happens totally changes its meaning. If it happens after taking out a major high or low on the outside of a range, that often signals a huge reversal. But if it happens inside an existing range, it's more likely just a sign that the current trend is going to continue. And this brings us to the final and most critical pieces of the puzzle, putting it all together with the right timing and, of course, managing your risk like a pro. Remember that checklist? Well, session timing is a huge validator. A big, aggressive move in the middle of a low volume session is, well, it's pretty suspicious. But that same move during the London or New York kill zones, when all the institutional volume is flooding in, that's a move you can trust. Timing is like a final seal of approval. And finally, your stop loss. Please stop placing it based on a random number of pips. Your stop needs to be logical. You place it at the exact point on the chart where the story you're trading is proven wrong. For a long trade, that's usually just below the low of the pullback. That way, you're letting the market structure, not your emotions, tell you when it's time to get out. So, after all that, what's the one single idea you need to walk away with? Let's bring it all home. And this right here says it all perfectly. The amateur trader chases the explosion and becomes the fuel for the institutions. The professional understands the whole sequence, waits patiently for that confirmation on the pullback, and gets to ride along with the smart money. Patience is your ultimate edge. That's the question. That's what you need to ask yourself from now on. Stop being a spectator who gets caught up in the chaos. Start being an analyst who can actually read the story behind the price. I promise you, that one shift in perspective will make all the difference. Thanks for joining me.